So at this point in time, what I'd like to do is have Maggy come back up and join us. As you heard from her this morning, she's our product lead for compliance and insurance. Along with Maggy, we're going to have Bill Donegan, who's the Chief Compliance Officer for Scotia Securities, Paige Wadden, Head of Compliance, and Martha Kane, VP of Compliance at Credential. Today's presentation is really going to be a panel discussion with these experts on the regulatory challenges that exist and how they're currently managing them. Maggy, over to you.
Cool. First, I got to kick these guys out. I know you all want to be in compliance, but you can't. So Paige, Martha, Bill, we're just changing into the view. Or Oprah, whatever. Great set change. Like it? We don't have to stand. We can sit down, have a conversation. Compliance people. Are y'all excited? We are.
I am. I'm absolutely excited. I love this stuff.
Like conferences or compliance?
Both.
Especially when compliance is at the conference. We keep you all in line. So the first thing we thought we would talk about, besides Policy 2 being in effect for the past year and everybody managing through it, is leveraging and how different types of dealers handle that. So we'll start with Bill at one end and we'll work our way around. Leveraging, we know, is a critical part of Policy 2. How is your dealer's overall approach to leveraging? Is it allowed, supported, is it encouraged?
Just start by saying that leveraging is probably one of the higher risk activities that a dealer engages in. So, you need to have a higher level of scrutiny and care around it. Especially now, there's for example, a class action going on against a dealer with regard to leveraging practices. The MFD have just started a regulatory proceeding with respect to leveraging. And so there's significant reputational and financial risks involved. Is it allowed? The short answer is yes, but subject to supervision and compliance and suitability requirements and a whole raft of basically new requirements that most dealers probably didn't have about 3 or 4 years ago, but which have now been brought in. Is it allowed or supported? Well, yes and no. Like, it's supported to the extent that it's within the compliance requirements, but not supported to the extent that there aren't marketing people and training people out there training staff on how to do leveraging programs and actively encourage them to go out and do them. And is it encouraged? I think I've already answered that. The short answer is no. And that really wasn't a compliance decision. That was a business decision about the type of business that they wanted to pursue. That's my take. Martha?
Okay. Well, the reason I'm sitting here is because we already established that Bill will give the most fulsome answer, and then the rest of us will just add to his.
You can start next time.
No. Actually, that's exactly the plan. We had our meeting. You weren't on the prep call the other day.
Yeah,
so.
That's the cost of not going on the call.
So we service the credit union system, and so definitely we do support it. Of course, the credit unions are lending institutions, so we're very open to leveraging. However, that's not that we encourage or discourage it. We do support those types of activities.
Worldsource supports the independent model, a little bit different. And at the end of the day, if it makes sense for the client and it's done properly, that's okay. We're not going to sit back and say, thou shalt not, but we are going to put the rules and the parameters around it. So what we've done at Worldsource is we've put together a really great internal process and system that the advisors are trained on. They're well aware of it. And if you jump through those hoops, and I hate to make it sound like that, but if you're jumping through the hoops successfully, then it's gonna fly. And if it's not, then it gets stopped right at the door and it doesn't go forward. So Leverage can tend to be a very bad word out there, but if it's done properly, if it makes sense for the client, and if the dealership and the advisors are all on the same page as to how it's supposed to look, then it's going to be successful.
With all the regulations that we have and the measurements in place and the supervision around it, are you seeing advisors having an increase of leveraging or selling leverage products, or a decrease in it in your day-to-day operations right now?
Well, I think the RSP loans continue to be a strong business, but that's not the leveraging that requires the higher degree
Yeah,
of
we're not worried about
supervision.
those.
The one thing,
You can RSP out.
the large scale loans,
Yeah.
I think in my experience anyway, definitely a decrease there. Probably a result of two things. One is the heightened supervision that dealers have. Now, when advisors know that they're going to have to make a good case for a leveraging plan, where before that wasn't the situation. Also, I think after 2008 and 2009, customers and advisors are much more risk averse because they saw some of the bad situations that occurred when in leverage plans over that period, and they're probably more risk averse. The only, just as a throwaway, the one thing we're seeing an increase in is small loans for TFSAs. And the TFSA isn't exempt from the heightened supervision under Policy 2. So, I mean, you got to approach those a little bit differently because they typically are very small short-term loans. But that, if there's anything that is a new trend, that's it, the small TFSA loans.
At Credential, we don't do much leveraging at all, even though, as mentioned, that we support the credit union system that are lending institutions, but we don't see a lot of borrowing for the purposes of investing. So the trend, there hasn't been an increase at all in that regard, or a decrease. We run quarterly reports in addition to other ongoing, just to see the overall trends and whatnot, and again, not much difference there. Where the trend is increased focus by the regulators. We, of course, as we're discussing, we've just gone through our IROC audit, and just like the MFDA audit, just prior to that, the number one focus by both regulators was in terms of leveraging and reviewing of all the cases. Automatically, MFDA, if you're $100,000 investment, if you're anything under medium, 100% medium risk, it's automatically tagged for review, and they're basically pretty brutal that they will deem it unsuitable and make you go back to the client and speak to that and make adjustments, either closing it down or whatnot. So at a dealer level, no, we haven't seen an increase in trend, but a regulator definitely.
Yeah, we haven't seen an increase either. We have pockets of advisors who traditionally have done leverage, and they continue to do leverage, and they've adapted with the regs that have come down and with our processes that we've put in place. And then we've got the other side, which is, of course, the majority that say, don't leverage, won't even think about it. So we haven't actually seen an increase, but those who traditionally have done it continue to do it.
So for the past year, with leveraging being a critical component of the MFDA coming in and auditing you, what type of processes have you put in place, and what challenges have you experienced with those processes, education-wise, talking to advisors, or just in-house in your own head office? How do you manage those? We all look to you, Bill.
At the supervisory level, basically, now when an account has leveraging in it, it gets flagged as leveraged in the system. A lot of what we call leveraged information is put in the system. Basically, it's the information needed to make an assessment under the MFDA leveraging suitability criteria. And that gets reported up on the blotter, and it's looked at by the supervisory staff. In addition, a leveraging, what we call a suitability checklist and worksheet is used, and that has to be submitted in cases where the leveraging doesn't fit within the established MFDA criteria for full review. And that, the advisor has to make the case for the suitability of the program, and more often than not, they're probably not approved. And that's a good educational experience for the branch and for the advisor. The other thing we do is we brought in a monthly report which just captures all of the leveraging activity in the dealer over the previous month. And it's a spreadsheet with columns that have all of the account information that's recorded in the system around leveraging and KYC, account type, and so on. So we use that as a second level check on what's going on out there, and it allows us to look at trends as well in certain branches and with certain types of products. So we have that second level check, which isn't an MFDA requirement, but which is something that we do internally.
At Credential, we've had leveraging, pretty fulsome leveraging policies in place for over 5 years, and so much before even the MFDA required it. We have, as Bill has mentioned, we have suitability checklists and worksheets to actually help the advisor go through it. Because we don't encounter it very often, it's a real training issue or knowledge issue if in fact they haven't done one for a long time or have never done one. And because it is such a high-risk process, and gets a lot of attention from the regulators, we want to make sure that we're not going to find out about it at time of complaint. Like Bill's process, if in fact there are any potential red flags, either they have to, it actually either gets stopped there or it has to go on for review to the BCM or even to the head office. So we want to make sure that if it's supposed to go through, it goes through. If it shouldn't go through, then it gets stopped at that point. In fact, we just had an incident the other day where a client came in with an article from the paper and said, well, I see that someone else didn't profit from their leveraging and they got fully rebated from the dealer, so I would like to get mine as well. And so obviously there's a lot of encouragement through knowledge of what's going on that sometimes that encourages complaints as well. So you have to really have good upfront processes.
We have suitability worksheets as well, all built with the back knowledge in there. And it's great. It works wonderfully. We too went through our MFDA audit this year, and we worked with the MFDA to even perfect that little bit much more. And so now it's even better than it was before. A big challenge for us has been those advisors transferring in who already have the leverage on the books. And I mean, that's a reality. You can't leave part of your account. You're bringing it all over. So for us, we had to look at that, and we realized that it was an issue. So we've done individual suitability checks on all of these clients, and we've contacted all of these clients to let them know that perhaps the investments that they're in and the strategy that they're in isn't exactly the best for them at this point in time, and giving them options and basically asking them to sign off on it. It's kind of it's a double check on whatever went through at the previous dealership or didn't go through at the previous dealership is being caught now, and MFDA was very happy with that.
So what I'm hearing too, a lot of this is a manual process that has still had to be put in place, and I can just go on the assumption that there might be a smart app to help at some point in time, because it is extremely costly for your individual companies to manage just this one product or product type or of leveraging. So
well, and it is the training issue as well.
Yeah.
I mean, you can flag it on the system, but you only flag it, and that only works if you're flagging it.
Right.
I mean, so it's
And
actually
then if somebody
educating
knows.
them. So
Yeah.
it's about keeping them aware of the issues.
right.
But yes, Maggie, I do agree that I believe that there could be some functionality that
I'm just playing on Richard's,
that could assist in those processes. And I
Yeah.
can think of a few. We can discuss them after.
Okay. Yeah. Anybody else out there with leveraging issues over the past year that you want to bring up before we move off leveraging onto something else? Because we have a whole bunch of clients out here. I'm sure you're doing leveraging. Anybody want to add to the topic? We're on The View. We got The View happening. Audience. We're giving away water bottles. Okay. I always wanted to do that. Oprah gives everything out to her audience. I don't have nothing to give away. We only had a half an hour, and sometimes when you get compliance people talking, we don't know when to stop. So I do have to keep on target. I'm waiting for Vicky to give me my 10-minute sign. 10 minutes and then I'm going. But we have two other topics that we want to talk about, cost disclosure and performance reporting. So with those two likely coming into effect in 2013, what are the implications to these changes to your dealerships as they're coming through with 31103 and cost disclosure and performance reporting? How do you see that affecting you guys over the next 6 months to 9 months?
Yeah, this is a big one. Just to sort of back up and give an overview, the CSA released a draft regulation around cost disclosure and performance reporting last year, and it was out for comment last summer, and there were comments, and they took the comments back, released it again this past summer for comment, and there was a lot of industry comment about it. And I'll just sort of give a little overview of what it involves. The first piece of it is annual performance reporting to customers, and there's three sort of core elements that they want in the performance report. One is a comparison of net invested to what's currently in the account. The other one is a summary of basically money in and money out over the course of the past year in the account to show gain and loss over the period. And the other piece of it is return over time reporting. So to show, basically since you opened this account, you've had a X% gain or X% loss. The other piece of it is cost disclosure, and there's two little bits to that. One is disclosure basically of all the charges that the dealer makes on the account. Dealers are pretty good at disclosing that already. The more controversial piece of it is disclosure of commissions earned by the dealer with regard to the account. So the piece that would have to be disclosed, for example, is annually the amount of trailing commission earned by the dealer on a specific account. So that's basically in a nut. There's a lot more to it than that, but those are the sort of the high-level big issues involved. The complications are, first of all, from a technology and systems area. Secondly, in terms of, this touches your customer-facing document, which is a statement. So statement redesign and development around the presentation of this information. And training for your staff about how to explain the new statements, and communication to your customers to explain the new statements. So it's going to be fairly complicated to implement, and I'll turn it over to Martha.
We already have on our MFDA statements performance reporting, so we're good to go there. So that's ahead of the curve. And on the IROC, of course, they keep on changing the requirements, and it's going to be a lot more complicated on that side. And so, we're waiting to see actually how it all pans out. But there will be a lot of challenges to get the right information in order to actually do the calculation. And speaking with the regulators, they've basically said to the industry, I know it's complicated, but figure it out because that's what we want to happen. So, in earnest, the industry is doing that. But in terms of other than costs and trying to figure that out, when it does come down, I think that it will put a lot more focus on the advisor to have a good discovery process to do what they're supposed to be doing. So I don't think it's any more added pressure than should be there, other than to do their job and do it well. And I know that Univeris is looking at a new discovery process, and that will definitely help. And that will also help to manage the expectations of the clients, so that when there is a performance issue, that they can relate it back to that it wasn't a poor recommendation, that they don't have a crystal ball, and that's just the way that it is, because the MFDA views performance complaints as suitability complaints. They put them into the same bucket.
We're on top of it as well. I mean, certainly there's going to be a lot more for us to do and to make sure that we get it right. But again, we're waiting to find out what it is that getting it right looks like. Because, we put a lot of effort into this when they first started coming in with, the request for comments and thinking, oh, they're going to go this way, they're going to request this, we're going to have to do this. And nothing's been, set in stone, so we're not going to go down that road until we have to. But much like we spoke last week, our advisors are aware of it. It's constantly an education piece on our part whenever we have the opportunity to talk to them about the fact that this is coming. It's all about disclosure, disclosure, disclosure. So I feel really good that we're going to get their buy-in and that we have their buy-in, that basically this is just something that has to be done. So I think that they're starting to change their behaviors now to fit into that, even though we haven't actually prescribed what that looks like. It's going to be good.
Cool. Does anybody feel that there could be a conflict between the advisor and dealer in communication to the investor and what's actually going to go out on performance reporting? Do you have any sense of that at all, or is it just the advisor is going to say what he's going to say to the client, and your documents are going to come out, and that's what's going to be, what they're reading? Do you sense anything right now?
I really wouldn't have that concern. I can't see an advisor us allowing it, nor an advisor really wanting to go out with something different. If advisors are doing it, it's because that's not being done on their behalf right now. And so, the performance reporting will be the official performance reporting, and so no, I can't see any conflict in that regard.
Cool. So we'll move on to cost disclosure. And of course, that encompasses many different fee components that we have in the mutual fund side. How do you know, and will you be able to provide the costs associated on particular trades at the time of the sale and the expectation of what is required to be produced? Do you know everything that you have to disclose and put out regarding the costs?
Well, I think the biggest challenge is going to be delivering the disclosure with respect to trailing commissions, because right now, traditionally, dealer systems don't break out trailing commission at the account by account level, so that there isn't the ability right now to deliver, say, information to someone to the effect that Mackenzie paid the dealer X dollars over the past year with respect and trailing commissions with respect to that account. So that's something that's going to have to be figured out and built. At a higher level, IFIC have given a lot of feedback, and a lot of dealers have given a lot of feedback to the CSA about philosophically whether this is the right thing to do, from the point of view that customers may be seeing that these commissions are flowing with respect to mutual fund products, but they won't see any disclosure like that with respect to insurance type products or other types of financial products where there may well be embedded commissions flowing. So it's probably going to be, it could potentially cause customers to think that their mutual fund products are more expensive than other products that are available in the market. So there's probably a serious issue about whether or not this disclosure should go ahead in the absence of a more broader-based type of disclosure across all of the products that compete in the same market for the consumer's investment dollar.
Yes, there's two areas, of course, that is the trailers and whatnot on the statements, and then there's a requirement to disclose certain things at time of trade. I think putting the information about the trailers on the statements, that's going to bring to the attention of the client how much that they actually are paying a dealer for that, and I think that'll be a very interesting time, interesting for lack of a better word, because there's going to be a lot of pressure on that advisor to have an understanding what their value proposition is, to be able to earn that, see the value in the client's eyes. As Bill said, there is not that same disclosure on the insurance side, and if they could only see what the advisor was making on an insurance policy, now there's probably a reason for concern.
Depends on who you're asking.
Well, and the reason for concern in their eyes versus the trailers, I'm not saying it's not justified, it's a different price pricing mechanism, different pricing schedule, but I'm sure they still earn their ways. But in terms of the disclosure at time of trade, I think that it's good information that they should be passing on. The regulators seem to be fairly fair in the regard that if you can have access to the information, then get it. If you can't, then give estimates. And if it isn't your duty, like if you are transferring in something from another dealer, then you don't have to go and look up what those withdrawals or DSC fees would be. You would just bring to their attention that there may be and to look it up. So I think that what's important is that the firm educate the reps on exactly what the disclosure is and what disclosure they don't have to give.
Same?
Absolutely.
Absolutely. Okay. Which leads me to one of my last questions, if not my last. How many? Oh, I got a question.
I was just wondering, has there been a discussion between the fund companies and the dealers as to who's going to absorb the cost of reporting, say, for example, the parsing of trailer commissions on a client-by-client basis? It would seem to me that the fund companies hold that data somehow or another. Are they going to take responsibility for transmitting that to the...
Well, yeah, like part of the proposal is that the fund managers have to make the information available. FundServe are going to have, and my understanding is that they're going to be proceeding with developing it. FundServe will have to develop the mechanism to deliver the account level information, and dealer systems at the dealer level will have to be able to take that information and get it annually into the right place on a customer statement. So the answer is that there'll be cost at the manager level, the FundServe level, and the dealer level.
Presumably at the client level, right? Yeah, and that's the thing where it's incumbent upon the regulator to actually do that cost-benefit analysis and demonstrate that it's worth it for the client to actually be paying for that.
One of IFIC's comments was that, in their opinion, there was no meaningful analysis of the cost and the benefit associated with this.
Cool. Which gets me to, I guess, now my final question. Do you see, because of this cost disclosure that and the cost around it, that dealers may go to a more fee-for-service based approach, single fee and just disclosing that versus what could be coming down the pipe?
I mean, that's bigger for us on the IROC side. Already, fee base is already there. We have a few on the MFDA side that are dabbling in it. It's a hit and miss, really.
Yeah.
You know, it's too hard to say, depending on what they come down with at the end of the day. It might make more sense for them to go that way, but...
I would say that it should be unnecessary because, of course, mutual funds are a fee-based product already. However, the writing's on the wall that any product with embedded fees, the regulators are turning focus to. We see in the UK and Australia that trailers actually have been disallowed. And actually at the Fidelity conference the other day, which I understand was quite good, that they were brought to the attention of the attendees that there's going to be a new line on the fund fact sheets, something to the effect that the trailers create a conflict of interest for advisors. So, you know, that's kind of an unfortunate statement, and so with all that, it's probably a good idea to consider even on the MFDA side, as well as where it's naturally conducive on the IROC side, to consider fee-based accounts.
The IROC paper that's currently out for comment on the issue makes the point about suitability, so that, you know, and the point they make about fee-based accounts versus commission-based accounts is that the account type needs to be suitable for the customer. So if you have a customer that, you know, doesn't do a lot of trading, then maybe a commission-based account might be more suitable for them than a fee-based account. The other thing that's coming, and Martha alluded to it, is the CSA are saying they're going to be releasing a paper on compensation structures, which will be exploring this issue of, you know, what they consider to be the conflict inherent in a commission-based compensation structure. So there's going to be a lot more to come on that issue, I think.
The other thing that we're finding is that our advisors are not just one-trick ponies. right? It's not just all about mutual funds. We've got, certified financial planners, we've got divorce specialists, we've got tax specialists, we've got people that want to offer the full package. And so for them, they're starting to look at the fee-based structure because it just makes sense. So if anything's going to direct our guys, our MFDA women, people, advisors, toward a fee-based model, it's going to be looking at the holistic and what they can offer.
Right.
So that's going to be more of a driving factor.
Yeah, I was thinking of it, it would be easier for most advisors to be able to show the value to a customer in a fee-based approach than every individual product that they're selling and have to justify the costs around each one of them. I'm not an advisor and never claimed to be one, but I think going out with this is my value proposition and this is how I do my businesses and this is what I bring to you, it's easier to explain that, I think, to a consumer today.
That's a stretch for a lot of advisors, though. I mean, they're just not comfortable with that.
Yeah.
They don't know their value proposition. And so I think that's where the opportunity is. Fee-based accounts are at a basic are just a different pricing mechanism. And so, you shouldn't have to have additional services or so forth because you put the fee outside versus embedded in mutual funds. However, it provides a great opportunity to actually, put in your tax advice, your financial advice and whatnot, and earn a higher revenue because you're having a different package, different service offering.
Cool. Throw it open to the floor if anyone would like to ask one of the expert panelists a question before we go to break. I think we're on break after me. Yeah, go ahead.
The sales costs for direct sellers of mutual funds are embedded in the management expense ratio of their funds. And typically there's no trailers involved. Or there may be some incentivization for sales staff who are directly employed. And yet the cost is still there, the cost of marketing and sales. So how is the industry and how are the regulators proposing to disclose the full cost of marketing and sales and support by direct sellers as opposed to fund companies that distribute through dealers, through non-proprietary dealers? Have they discussed that at all?
I personally haven't heard any discussion.
Because wouldn't the banking system be an example of that, for example?
Well, no, it just depends on the dealer model and if the dealer receives trailers. If the dealer receives trailers, then the dealer needs to make some sort of disclosure. So it depends on the model.
So if you have staff who are on salary selling your funds in a bank branch, for example, and not receiving any trailers, it doesn't seem like a fair disclosure.
Well, I'll just point out that the staff may be on salary, but the dealer could still get trailers. So it's
still
not
have to disclose.
sort of
Yeah.
that doesn't end the story. Companies that have salaried staff may still at the dealer level get trailers from mutual fund distributors. So
Yeah,
it's not as simple.
I'm
There's
thinking
no
more
simple answer.
Proprietary product.
But even
Yeah.
then, when
Even
you're
then.
talking about
Even then.
when you're talking about disclosing revenues, it's not at I'm getting this as an advisor. It's this is how much you are paying, regardless of where that money's going.
Yeah, like even in an independent dealer, the dealer would have to disclose not the trailer, which eventually gets to the specific advisor, but the trailer received by the dealer before the dealer takes their share out of it.
So there is really no difference whether or not that they're salaried or commissioned because it's on the gross to the dealer basis.
Yeah, so it's the amount received at the dealer level that's important on this, not whatever gets down to the advisor at the end of the day.
I guess the question then becomes, would there be a way for banking institutions to kind of avoid disclosing those commissions by,
No.
instead of paying trailer, directing revenues from a different?
Yeah, well, if they're the same
No.
company essentially, then, like I'm thinking of even GDC or some of these companies that deal direct, the way PH&N used to, if their sales staff are salaried employees and it's all embedded in the MER, then really a fair disclosure model would be disclosure of the MER. And because you've got embedded sales and marketing costs in one that just aren't categorized as trailer commissions.
Yeah, that was a comment by IFIC the first time around, was that we're disclosing the MER, which really is the cost to the customer. The trailing commission You know, if you see a trailing commission and MER together, you might think that they're different things and that it's costing you more than it actually is. If you want to tell someone what the real cost of the product is, it's the MER, not the trailing commission.
I agree.
So I have been told my time is up. So it was great to have you guys up here and sit with you because you are the experts in this industry in my mind. So I thank you for coming in and sharing your thoughts on this topic. Thank you.